technical. Sao? Okay, almost complete, so let's start. Welcome Anne to the class. Great to have you here. So this afternoon we will basically finish this cost of capital kind of thing, and we know if we want to value the firm, and that is the machines or the assets, and we need to know how expensive are debt and equity. And we know that equity doesn't have a price tag on it. There is no requirement to pay a certain interest rate, but there is the expectation of the shareholders. And shareholders hate risk, so they require higher returns. And we see this by the empirical evidence that highly risky shares basically have higher returns, and a higher return is nothing else than a worse price. If you sell a high-risk stock, that is identical to a low-risk stock, so all the dividends, the profits are the same. The high-risk stock will trade at a lower price. So if you sell these stocks to the market, you are the next Elon Musk, then you pay the price. So you have a good reason to try to bring down the cost of capital. It will increase the share price, it will increase your wealth. And therefore, we can talk about the cost of equity. It's an opportunity cost. It's not a price tag, but it is a real cost. And the CAPM basically tells us beta is what we have to look for. Simply because what I would just write away. Only the systematic risk is what the average or the majority of the shareholders basically suffer from. And we simply ignore the Vietnamese people that are restricted from investing into the world market portfolio, and we restrict from Elon Musk and private equity firms that for other reasons have other investment strategies and do not invest in diversified portfolios. But if we, under CAPM assumptions, everybody is an efficient, small investor, unlike Elon Musk, unlike the private equity fund who cannot change, who does not have a voice on the company. Yeah? So he is looking only at risk and return. He is not looking at corporate control. Elon Musk is going for at least 50% in his firm simply because he needs the control, because he makes money not from risk-taking, but from actually becoming a dictator, having great ideas, and basically forcing the companies to basically exercise his ideas. And if you ask the Tesla small shareholders, what would you prefer to do? Probably a completely different corporate strategy would come out. Elon Musk is a visionary, and he wants basically to have the control to turn his visions into reality, and therefore he is completely different from the investor in the CAPM. The CAPM investor is a person like me who basically realizes that efficient portfolios are better than inefficient portfolios. And efficient portfolios is simply a portfolio where, if you think in return, this is of course expected return and risk, and here it is, then it should not be possible to go to the north, and it should not be possible to go to the east. If there is another portfolio here or here, then X here is not an efficient portfolio. Efficient means given the risk, the best return, or given the return, the lowest attainable risk. Simply because people want return and they hate risk. So the efficient, if we draw the efficiency line, we feel this, but basically all the securities, all the portfolios that are possible, are in some area, and then basically we try, with forming security portfolios, to go as much to the north and as much to the west in this diagram as we can, and everything that cannot be improved is called the efficient portfolio. And then comes theory. It says an efficient portfolio. No, the market is an efficient portfolio. That's a bold statement. In theory, it is like this. People realize that this is the best portfolio, P-star, that everybody should do. In the CAPM, everybody has precisely the same information and is doing precisely the same optimization. So everybody comes up with the same portfolio of desired securities. And if we say supply equals demand, the supply is the market portfolio, and the demand is the P-star, the portfolio that all people want to have. If something else is offered, suppose the stock market is not yet existing in the United States, but tomorrow we open the stock market, and then the S&P 500 and all the other stocks are basically sold. Nobody has any stock yet. Everybody can declare, I want this portfolio. If everybody says, I want to buy P-star, and M is what comes to the market, that cannot be in equilibrium. So the market portfolio must be the P-star portfolio. It's a simple economic argument that in equilibrium, what is offered must be sold. That supply equals demand. That basically leads us to the conclusion that the market portfolio must be the efficient portfolio. It is almost like a self-fulfilling prophecy. There is no argument just besides the simple fact that every share that is sold is also a share that is bought. That supply equals demand. Very simple. Nobody has ever proven that the market portfolio is efficient. It's really just a theoretical conjecture based on very simple economic arguments. The theory just tells us, portfolio theory that you studied in the asset pricing class or in the interest things, just tells you that you can calculate P-star from a rather complex mathematical optimization. You clearly need computers. You clearly need huge amounts of data. A complete covariance matrix of security returns. Something where basically most people say, I don't have the data. Where should I know what P star is? I can't calculate the P star. But remember, it's just a theory. Markowitz basically said, suppose a world in which everybody has complete information, can do all the mathematics, then everybody would like to go to P star, and then this must be efficient. And then of course this efficient market portfolio is what drives the risk. Now we can calculate the equity beta as we already. The equity beta basically can be found by a regression, simply because a linear regression has a slope, and that is exactly the same. It's the same beta than the CAP-M beta, and so beta towards the whatever we use as a market portfolio. The market portfolio, in theory, is the market of all risky assets that are traded and that can be bought. Because the market portfolio is basically all risky activities that are brought to the securities markets, where the investors meet and basically allocate the risky securities among each other. And the S&P 500 is quite used as a proxy for the market portfolio, simply because it's the biggest portfolio. But of course, not every portfolio is included in it. It's only 500 firms. The US stock market has roughly 10,000 firms. So it's really only a proxy, but empirically it doesn't matter at all whether you use the S&P 500 or you use all 10,000 securities. If you calculate the equity beta on other market portfolios, the impact is so small. Just for practical reasons, people are happy with the S&P 500. In the end, we need this beta E to calculate the equity costs, but we put historical data in it. And the historical data are, of course, all just random drawers that contain errors and surprises, and pure noise or randomness. So whenever you calculate something with empirical data, you always have a degree of uncertainty. You need a huge amount of data in order to precisely measure something. But here, of course, we know that the world is changing. Tesla was not the same risk 10 years ago than it is today. If you would measure the beta of Tesla and you regress it, you basically make the assumption that its beta is constant over time. So knowing that every time period, the risk characteristics of stocks change because they have new investment projects. We are always in empirical work comparing apples and oranges. So we don't even think that there is something like a precise beta that we can precisely measure. And that's why the question whether the S&P 500 or some broader market index is the better market index is of minor importance, given the fact that beta today is different from beta last year, but we use last year's data in order to estimate this. And what we see is profound interesting differences. Edison, 50% beta, and here advanced micro devices, semiconductors 2.83. So you see stocks react very differently, or the regression coefficient is highly, highly different. And if you would compare this with the volatilities, of course Edison is also a low volatile stock, and advanced micro devices has much more volatility. So the standard deviation also goes up with these stocks, but it's not the same. And there is not a one-to-one relationship between overall risk and the beta risk, between systematic risk and the sum of systematic and unsystematic risk. By the way, the average beta of all firms is roughly is exactly 1 by definition. Yeah? The whole market is basically the average firm. Yeah? And if you regress the market on the market, the slope must be 1. Yeah? So there is basically a fundamental law that the average beta must be 1. Yeah? So above 1 means more risk than normal. Yeah? Less than 1 means less risk than the average. Yeah? And Google and Microsoft, yeah, surprisingly, they are handshake firms, yeah, but they now arrive at beta of 1 simply because they have become much less risky over time. Yeah? Google is actually a very, very strong cash cow. It's producing billions of advertising revenue every year, and that is highly stable. Yeah? And it used to be a very high beta firm 10 years ago, yeah, when it was yet unclear how successful the business model would be and other things. Yeah? By the way, Microsoft and Alphabet, of course, are well known for having no debt at all. Yeah? If they have something, it's cash. Yeah? It's like negative debt. Yeah? And we know, of course, that the more debt you have, the higher the beta must be. Yeah? The risk of the assets plus the risk through leverage is affecting the volatility of the stocks. Yeah? And both beta and the volatility would go up and down with debt. Yeah? So one reason why this company may have such a high beta may be not only that the assets are highly risky, yeah, but also that there may be a lot of debt. Yeah? We still don't know. Yeah? But keep in mind, both the equity risk is a function of asset risk and of leverage. Yeah? And maybe Microsoft and Alphabet have assets that are more risky than Walt Disney, for example, but Walt Disney had a lot of debt, and Google does not, yeah? And that's why Google in the end ends up with a lower risk. Yeah? And as if you think about the cost of capital of Alphabet versus Disney, now we think, oh, Disney looks more risky, because Disney here has a 1.3. Yeah? But it could well be that Disney has lots of debt, and that's only the reason why their equity is rather expensive. Okay, and now let's go really to the theory. Yeah? American textbooks usually tell a lot of stories before and only afterwards introduce mathematics. For Vietnamese people who are not afraid of mathematics, that's actually the wrong way around. You should do the precise argument first, then hopefully understood by the students, and then you tell nice stories, and then people realize what they can do with the strong theory. But American students stop reading once they see a formula, so the formula comes at the end of the chapter, and there is only storytelling before. But the theory is this one. This is the so-called security market line of the CAPM. Basically, when all the CAPM assumptions hold, investors all have the same information, or investors use the Markowitz framework in order to select their portfolios, and then there's market equilibrium, where supply equals demand, and some other thing. And if this all holds, then the expected return of every single stock must be the risk-free rate plus a risk premium. And the risk premium is basically, well, this is called the risk premium. And this is called the amount of risk. How much risk does the stock have? And only beta, nothing else counts. So beta is, according to the CAPM, the correct measure of risk. The other risk, the unsystematic risk, is not there. This is basically the amount of risk, and this is the premium per unit of risk that is required by the shareholders. And of course, we also don't know what the expected market return is. And what practitioners usually do is, well, I told you yesterday that after the crisis, all the people were very, very risk averse and preferred the safe haven. The risk aversion of people is not constant over time. Human beings react very much to current moods and to the financial news. When there is something like a financial crisis, people become extremely risk averse. And the risk premium required by the market go up. And when the people are all satisfied and are very positive and optimistic about the future, the risk premium may go down. And it's clearly naive to assume that this is constant over time. Yeah? But we have no other way to estimate the risk premium than to look very, very long-term into the past. Yeah? When I wrote here before the break that 5 to 7% is the risk premium that most American investment banks use, it is simply based on the observation that in the United States, over a 100-year time period, stocks outperformed the risk-free rate by roughly 5 to 7%. Yeah? And other countries have different experience. Yeah? But amazingly, it is rather similar. Yeah? But Japan, for example, had the huge stock market crash in the 90s. Yeah? They have quite different stock market experience. Many countries have wars where basically everything was destroyed. Yeah? And in Germany, basically all the time series only start after the Second World War, or if we have complete time series, then there's a break. Yeah? No stock price available during the Second World War. And yeah, you may say this 5 to 7% was the experience of a country that never lost a war. Yeah? And that may have made lots of profits from the war. Yeah? So if you were the investor of a military producer in Germany, you basically lost everything. Yeah? That stock went bankrupt. Yeah? If you are the shareholder of an American company producing tanks or rockets, you made a lot of profit. Yeah? So maybe the American, just because Americans by chance have been winning all the wars in the last 100 years, maybe this is too high. Yeah? American shareholders were happy. Yeah? And they took a risk and they were rewarded quite nicely with 7%. Yeah? In Germany also many people took risks and they lost all their money. Yeah? So what the right risk premium is actually completely unknown. Yeah? We know that it's not constant over time. We know that the historical risk premium is different between Japan, Germany, and the United States. Yeah? Many countries have only a small period of data, and that is not useful at all. Yeah? In Vietnam, for example, you have more years when shareholders lost money than years when shareholders made money. Yeah? You had a very strong beginning when the stock market opened, but then there was a big crash. Yeah? So if you calculate the relation here, it could well be that the risk premium is negative in Vietnam, because there were more losses than returns. Yeah? Would you conclude then that the people are risk-loving and are willing to buy shares even if they are loss-making? No, clearly not. So we take the American evidence and basically believe that 7% is the risk premium. Yeah? In the end, don't forget that all these tools applied in practice have no other means than to affect financial decisions. If you are the chief executive officer of Siemens, for example, one of the largest manufacturing firms, and you heard in the class that risk is important, that shareholders hate risk. And all your engineers at Siemens think about risk completely different. When they think about risk, they mean reliability of machines, but they don't think about volatility of revenues and costs, volatility of the results or of the stock price. And you want to force them to think about this. Then it's quite easy to say, every division of Siemens now gets a beta. There is all kinds of different segments. And I employ McKinsey in order to find the betas, and they do it on a fair basis. And then I distinguish the high risk from the low risk areas. And then I basically say, okay, and for every unit of beta, you have to return 7%. And then in the future, if you implement this, in the future, of course, the divisions with the low beta will find it much easier to finance their investment projects. So all this shareholder value doctrine was basically an instrument applied by chief executive officers in order to turn their organizations into an organization that is more, that has a closer eye or ear to the capital market. And they were not concerned at all with the precision to measure something. They simply said, in our corporate calculations, we have to bear in mind that risk is costly, and this is an easy and quick way to measure risk. and to make it costly. Yeah? Simply by requiring a higher return for risky activities. Yeah? And the CAPM was simply at the point of time when all this was invented. Yeah? And basically it was the 80s, roughly. Yeah? The CAPM was invented in '64. Yeah? It took roughly 20 years for the people to really understand what the CAPM is. Yeah? In the beginning, this was only accessible for mathematicians, yeah? and most business people would say, yeah, I have no clue what Markowitz actually meant. Yeah? But then it made its way into the textbooks, yeah? And all the MBA students in the United States now learned this formula. Yeah? They started working at Siemens and elsewhere, and then they wanted something, yeah, to make their corporations more risk-aware, more lenient to the capital market. Yeah? And they simply took the easiest formula, the only formula that they had. Yeah? And they looked at the textbooks, saw this formula, and said, yeah, this is it. Yeah? This is how we want to steer our companies. And then it has basically become a kind of a consensus worldwide to use this model. Yeah? Nowadays, this is, from an academic viewpoint, is completely outdated. Yeah? The CAPM is the worst model in the empirical view. Yeah? There were so many other models, yeah? Asset pricing models that you have been studying in the asset pricing class, yeah? That empirically do a much better job in explaining the risk premium. Yeah? And Farmer French and Carhart and some others would say this is only one and the least important, yeah, of 5 or 6 different risk premium, yeah, for other kinds of risks. Yeah? But at Siemens, people say this is enough. And also the investment bankers today. Yeah? Investment banks are high-paid professionals, yeah, but they all say this is enough. Yeah? We know that there are better models, yeah, but for the job that we are doing, yeah, in order to find an undervalued firm, we take it over by private equity in order to make Siemens more risk-averse, yeah, and channel the investments into the right things. This is sufficient. Yeah, that's all to say on this slide. And let's, I think instead of going here, please have a look at this here. What is the difference? Here are expected values, here are realized values. If you do a regression, of course you have realized values. Yeah? But what is the realized value? Yeah? You first bring this to this page here, to this side here, yeah? And basically say there are 2 excess returns. Yeah? We call this the excess return of the stock, and this is the excess return of the market. Yeah? And if we want to work with empirical data, yeah, we simply exchange the expected values with the real values. Yeah? And then this could be, the beta is of course missing. Yeah? If we regress RE minus RF on RM minus RF, then we get the slope and the coefficient should be beta. Yeah? So this is basically the empirical version of the security market line. Yeah? You use realized excess returns of the stock, realized excess returns of the market in order to find beta. By the way, of course, we also know that beta E is the covariance of RE and RM divided by the volatility of RM. And here again, you don't have expected values. You can either do this kind of regression, or you directly use Excel or whatever program to calculate the covariance, and then of course you have real returns of the market and the stock image. And both ways here are identical. Yeah? So this is theory and this is empirical implementation. And yeah, and that's just another way. Again, I really hate American textbooks quite often because this is not a regression. Yeah? This is an estimate, yeah? It looks like an empirical regression estimate. Yeah? And then of course I don't want an expected value in there. Yeah, I want a realized value in there. Yeah. One other example where our textbook is a bit sloppy. I actually don't know why this topic here is based on this slide, but let's simply just go through it. This is a buzzword that everybody should know: market-weighted portfolio. Whenever you think about portfolios, there are two concepts that are quite often used: equally weighted or market value weighted. And just as a little side away, equally weighted means you invest $1 in every stock. $1 in IBM stocks, $1 in Tesla stocks. Value weighted actually means you buy 1% or 10% of all Tesla stocks and of all IBM stocks. And then basically you purchase a percentage of the value. The overall value of Tesla is, I don't know, 170 billion. You invest 0.1% of it, that costs you so much money. We do the same thing for IBM. The market portfolio, of course, is a value-weighted portfolio. If you buy 100% of the market portfolio, you have all the stocks in the world. If every investor buys the market portfolio, he holds a tiny little part of that portfolio. But if in the portfolio there were 10 Tesla stocks for every IBM stocks, then you have to buy 10 times as many Tesla shares as you buy IBM shares. And if Tesla shares are very, very expensive and IBM shares are very cheap, then you buy 10 times the very expensive share and only 1 time the cheap IBM share. Because you want a fraction of the market portfolio. And don't care about the mathematics, that's actually unimportant. Just keep in mind that the market investor buys a tiny little fraction of the market, so he buys a certain percentage of all the stocks. And that's a huge difference from just investing $1 in every single stock, which would be an equally weighted portfolio. And then some traditional, practical things. If you do this here, of course you have to think about what is the risk-free rate. So we get into this regression. What is actually the risk-free rate? And here, the proposal is the long-term US government bond rate. And if you go back here to this formula, treasury bills look much less risky. So there is an ongoing debate: what is the appropriate risk-free instrument? Investment bankers usually say the only really risk-free thing is cash. Cash is $100 today, $100 tomorrow. Next to cash is overnight money. And a security that has only 1 day maturity. Because you know when you wake up tomorrow, it's still 100. A treasury bill is basically like a debt security with maturities between 0 and 90 days. So maybe on average it has 40 days maturity. It's very close to 0, but still, when you think about the market value, it is $100 that you get after 50 days, discounted over 50 days. It could be that the value is slightly changing simply because the discount rate is changing. The bill really entitles you to receive $100 at maturity. And the market value is simply the discounted value. And if you discount for only 40 days, this is almost nothing. So if you get $100 in 40 days, the price will be 99 point something, close to 100. But when the interest rate goes up and down, the value still goes slightly up and down. With corporate bonds or with government bonds, they have much longer maturities. And I don't know where and when, but hopefully you know what duration is, and then you have learned that bond prices react strongly to interest rate changes. Just think about this very simple zero bond. If you get $100, but it's in 10 years, and you do the following calculation. Yeah? And now you change the interest rate from maybe 2% to 5%. Yeah? Then the price impact can you just roughly guess the price impact? I'll give you some more practitioner rules. Yeah? This is a 10-year zero bond. It has a duration of 10 years. Yeah? And what every practitioner knows is that the percentage price change of the bond roughly equals the duration times the absolute change of the interest rate. Yeah? So this is 10 years, yeah, times 3%, yeah, from 2 to 5. Yeah? So this is minus 30%. Wow. Yeah? A huge amount of money. Yeah? You buy a US corporate treasury bond, yeah? Which has a special form of a zero bond. Yeah? It only has one payment and 10 years from now. Yeah? If you buy this when the interest rate is at 2%, yeah? Then the interest rates increase to 5%. Yeah? And this formula tells you that you lost 30% of your loss. Yeah? You bought a risk-free bond. It is risk-free, yeah? But the only risk-freeness is that you are guaranteed to receive $100 in 10 years from now. Yeah? But the risk is, of course, the market value risk. Yeah? The market value is dictated by the interest rate. Yeah? You have to wait for 10 years, yeah? So discounting over 10 years, yeah, has a huge price impact. Yeah? And the duration formula that all the fixed income guys know basically gives you a very easy way to calculate. Of course, you can do it in Excel itself. Right? Try it out and also find that the formula works. But the bottom line is 10 years discounting make a huge impact on the price, and only 40 days discounting make almost no impact. And that's why short-term security have less risk than long-term securities. Now, then why then does the textbook say usually it is the 10 to 30-year interest rate that is used as a proxy for the risk-free rate? I would say maybe the writer of this textbook was stupid and didn't understand duration. It was clearly not an investment banker. No investment banker would even think about a long-term government bond to be a risk-free bond. Well, if you do the empirics, of course, you can put anything into here. Yeah? If you derive the betas, it's commonplace to have long-term interest rates in there. Yeah? And the intuition behind it is very simple. Yeah? These assets here, they are here for the long run. Yeah? Tesla will produce cars for the next 10, 30, maybe even 100 years. Yeah? So a car manufacturer or a stock is by definition a long-term asset. Yeah? And then it's just a gut feeling that leads many researchers to say, I should compare long-term corporate assets with long-term safe assets. A stock, when people think about, do I prefer stocks or long-term bonds? I want to invest into the long-term, and the choice is actually long-term bonds and long-term stocks. But don't call it risky. That is really strange. And what people do is basically you look at the historical evidence. You look at empirical realizations of this and of this. And here you have monthly returns, and you may ask yourself, why monthly? Why not daily returns? With daily returns, you have much more observations. And then you may use ChatGPT in order to ask. I don't know whether ChatGPT knows it, but the wisdom basically is in the capital markets you have much noise in the short run. From 1 second to the next second, no theory applies. It's completely random what happens in the financial markets. From one day to the next day, it's still almost random. You have many observations, but they all contain much noise. And Yeah? But if you look in the long run, then you can hope that theory is visible. Yeah? It's much like, you always think it's exactly opposite of the weather forecast. Yeah? The weather in the next second is easy to forecast. It doesn't change. It's as now. Yeah? In one day, it's also possible to forecast. Yeah? But in 1 week, it's not. Yeah? In finance, it's exactly the opposite way around. Yeah? So we usually use longer term data simply because they have less noise, yeah? And therefore people believe that they are more, that makes more sense. We have to use them for the beta estimation. Yeah? And then there were empirical papers actually that compare the different estimation intervals and basically try to do this. Yeah? So this is how the data looks like. Yeah? And then you put a line in there. Yeah? So we have Cisco here, and 10% of the market corresponds to a 16% Cisco return. Yeah? But always remember, here is excess return. Yeah? In the textbook, you only read return, but excess return is what you really talk about. Yeah? Again, American language, quite often a bit unprecise. Yeah? They just use short words for longer things. Yeah? It is always the excess return that we talk about. Yeah, and this is basically the regression that we measure. Yeah. Now this regression compared to this regression has something added here. Yes, this alpha. Yeah? If the CAP-M is correct, the alpha should be 0. Yeah? Because CAP-M basically has the prediction of 0 alpha. Yeah? But of course, if you run a regression, just by chance the alpha will be precisely 0. Sometimes you even get a significant alpha. Yeah? And then you have a problem. Yeah? Then the empirical evidence is not consistent with your model. Yeah? But that can happen. Well, significant only means there is a 95% probability that alpha is different from 0. Yeah? So you can still say, okay, but this 5% CAP-M still holds true. Yeah? The problem is much of the empirical evidence is not consistent with CAP-M. Yeah? If we do regressions, and we often find significant alphas, much more than we would expect. Yeah? We would expect this in only 5% cases, because that is the error probability in a regression. Yeah? But we find it much more often, simply because we know that CAP-M is a bad model. Yeah? That the real world is not consistent with CAP-M. Yeah? But we love the CAP-M and still use it for our estimation. Yeah, and the error term, of course, should be in principle 0, or on average. By definition, the average also is 0. By the way, this function here is also a nice decomposition. Very advanced students in Frankfurt, I sometimes ask, how can you decompose? Well, CAP-M tells you overall stock market risk is systematic risk plus unsystematic risk. Yeah? Can you? Yeah. If we measure the risk by standard deviation, and IBM has a standard deviation of 20%, yeah? Can you tell me what percentage of this is systematic and unsystematic? Yeah? Then this is going to the solution. Yeah? This is overall risk. Yeah? This is systematic risk, and this is unsystematic risk. Yeah? So you can simply decompose the observed returns into the systematic and the unsystematic risk. Yeah? You can basically have an Excel file and then two columns with the two risk components, and can calculate the standard deviation of both. And in banking, I've been advising many banks on risk management things. The banks, suppose you're a bank and you have a trading desk, and your traders basically hold a long position in Tesla and a short position in IBM. And you want to evaluate the risk, then you basically say, okay, here I look into the past, they sometimes lose, they sometimes make money, and I take this as a risk estimate, and then I want to understand how much of this, what percentage is systematic, how much percentage is unsystematic, then you use this decomposition. But it's not in the core of our textbook here, just as a side remark. Yeah, and the interpretation of alpha, this is really something that just try the following thing. Ask ChatGPT how many financial textbooks on advertising, on investing do exist that have the term alpha in its name. And I will guarantee at least thousands of books. the alpha generating strategies is the most common buzzwords in investment. When you are an investment advisor or you run a fund that invests other people's money, then of course you try to convince people that even after your salary is paid, there is still a good performance for the investors. When I invest my money, I just buy the S&P 500. No investment manager receives anything. I just pay the computer costs to do the automatic trading, and I don't pay a manager to do the stock selection for me, because I just want the S&P 500 portfolio. But if you are a well-paid manager, you run your own fund, then of course your argument must be, I generate better returns than my competitors, and I'm worth my salary. Even after these costs, the returns that I pay out to investors are above the market. And alpha is just the buzzword in the industry for a return above or below the benchmark return. If you just invest from a CAPM perspective, you should expect an alpha of 0. So if you have an investment fund that has 5 years of historical data, and you put this into the regression, very much like the IBM stock, and you find this fund generated a positive alpha, it is consistently above the benchmark, and this is an empirical indication that the fund manager indeed is worth his salary. And he generates returns that are above what you would expect from the CAPM. If I would be convinced that this exists, of course I would not invest into the S&P 500 portfolio. So the very fact that I invest my money into the S&P 500 portfolio is a proof that I don't believe that story. But there are thousands of books that basically claim that if you select the right, well-paid managers, then you can generate alpha. And alpha is just another word for outperformance. You are better than the market, better than some other benchmark. And of course, benchmark means here a risk-adjusted benchmark. Given the level of risk, if you just think, here are 10 funds, did they outperform or underperform? You can simply compare them with the S&P 500 and basically order them by return. But that doesn't make sense because you compare apples and oranges. Some funds have high risk, some funds have low risk. And this kind of regression basically puts them all on an equal risk basis. Given this fund and also some beta, very much like the IBM beta, you can determine the beta of a fund simply by a regression. You just need past observations. And then you say, given the fund's beta, this is the expected return from the CAPM. If he is consistently better, then he has beaten this benchmark. So this is a risk-adjusted benchmark. Given the level of risk, that fund has a certain expected return. And alpha basically means that he outperformed. And that is something very different from just saying this fund in the past was able to outperform the S&P 500. That is not difficult to do if you just select high-risk stocks, do a very risky investment strategy, then on average, of course, you outperform. But that's not a reason for investors to put their money there. Investors are risk-averse, only if you outperform for the same level of risk. Given the fund's risk, they perform more than the CAPM said. And this is something that I could then not replicate easily. beta here for Cisco, whatever this is, yeah. Of course, when you do the analysis, yeah, this is your point estimate, but the confidence interval is, of course, rather wide. Yeah? So when you measure beta, it is always with errors. Yeah? We just take the point estimate, the expected beta, but be aware that every measurement is with errors. Yeah. So basically, this is the cost of equity. And now we go to the cost of debt, and afterwards we will think about this tax advantage, yeah? And then we do a weighted average cost of capital calculation. Yeah? So let's think about what is the cost of debt. And the first thing is that people naively think that they just have to ask a bank, what is my cost of debt, and take this as the cost of debt. Yeah? And of course, I have a high salary, I have a very stable salary, yeah? The government will pay until I die. Yeah? So from a bank's point of view, yeah, when I don't take on too big loans that are too big, yeah, the bank will say these loans are risk-free, or almost risk-free. Yeah? So my loan will be rather cheap, yeah? Simply because the bank anticipates no default of Marco Arnott. Yeah? If you do the same thing, the bank will say, oh, there is little wealth, little salary, and highly uncertain salary in the future. Yeah? So maybe this young student, unfortunately, will not be able to repay the loan, and therefore the cost of debt is much higher when you apply for a loan. Yeah? And the cost basically reflects the probability that the bank doesn't receive its money back. Yeah? But, yeah, and you are completely right when you say this is what I have to pay. Yeah? When I apply for a loan, I have to pay a high interest rate. When Professor Wagenborg applies for a loan, yeah, for reasons that I find fair or unfair, he pays much less than me. Yeah? But is this the cost of debt? Yeah? Think about, this is the capital market. Yeah? This is the expected return of equity. We want to see the expected return of debt. Yeah? We want to understand how much return is the bank generating. Yeah? And even if we pay 20% interest rate, but if we go bankrupt with 50% probability, then the bank will earn only 10% interest rate. Yeah? 20% with 50% probability. Yeah? So the bank will say, I make only 10% on this transaction. Yeah? So the cost of debt, from my perspective, is only 10%. Yeah? And that is what basically tells you this slide. Yeah? Yield to maturity. So this is the debt. Yeah? Somebody promises to pay 100 in 10 years from now. Yeah? If it's the government, yeah, we would discount with the government bond interest rate. Yeah? But if this is Tesla, yeah, the market may say 15% is required. Yeah? And the resulting price of the bond is, of course, very, very low. Yeah? So when Tesla promises to pay back 100 in 10 years from now, this is what they get. Yeah? Very small amount of money, and the American Treasury gets a large amount of money. Yeah? And implicitly, of course, in the contract is this hidden interest rate. Yeah? You get P, you have to pay back 100. Yeah? There was a huge difference, explained by the annual interest rate. So this here is the yield to maturity. Yield to maturity is defined as the interest rate that makes the theoretical value of a bond equal to the market price. Yeah? It's just the fundamental definition of a yield to maturity. Yeah? And if P is such that you have to put in 50% in order to get the price, whatever the price is, maybe $12.5, whatever. Yeah? Could be 20 or 60. Yeah? It is a function of the R. Yeah? And if you invest this at 50%, then 12.5 times 1 plus 50%, 10 years, of course, is 100. Let's put it at P, whatever it is. If you invest P, if you put it on a savings account and you get 50% every year, then you get 100. So you earn this 15% only, yeah, if you really receive the 100. But now the problem, when the government bond trades at 2% and Tesla trades at 15%, it is simply because if you invest in Tesla, there was a high probability that you never see this 100. Tesla may go bankrupt. So it's naive to assume that 15% is the earnings of the investors. This is only the earnings in the best case, and the best case is there was no bankruptcy. And therefore, 15% yield to maturity of Tesla bonds is clearly an overstatement of investors' expected returns. The investor calculates probability of bankruptcy, probability of no bankruptcy, what am I going to receive on average. So let's put a simple example to this. Let's say this is only 1 year bond with a yield of Y, and this is the promised payment after 1 year, and then with probability P there was a default, and you receive only what you are promised minus L, and L may be 50% or whatever. In bankruptcy you usually get something and you don't lose everything. The expected loss per $1 of investment. And then the expected return is, of course, you get Y, the promised yield. If there was no if there was no default, if there was a default, you only get this. And then you solve this, and you realize the expected return is the promised yield minus something else. And the something else is losses from default. And the textbook argues basically that if you say this is the expected return that shareholders get, you should also add here something that is the expected return that debt holders receive from that firm. The cost of capital is what on expectation that people make in money. And so there was an adjustment at least for high risk funds. If there was a high probability of bankruptcy, this really makes a difference. And therefore, people are a bit reluctant, basically, to take the market yield to maturity of high-risk companies and basically say, this is the cost of debt. Because there is this margin. In the corporate world, credit risk is usually measured by ratings, rating agencies like Moody's. There is also Standard & Poor's or Fitch, and they basically make money from giving kind of school grades to corporations. And if they say you are a single A company, then these companies have an average default rate of 0.2%. So 2 out of 1,000 single A corporations on average default in a year. But in recessions, that actually increases to 3%. And this is high risk, starts with a single B, 5% in every given year, but 16% in a recession. So if you are a company that has only a single B rating, then of course there was a substantial default risk, and you would clearly have an important adjustment. So if you assume that 60% is the average loss in bankruptcy of your money, and you have a B-rated bond, then you would calculate 5.5% probability times 60 basis points. So 3% below the bond's quoted yield is the expected yield. If you buy a bond, then the realized return will be 3.3% on average below the quoted yield. You get the quoted yield only if there is no default. So this was actually the first way to calculate the cost of debt. You have a firm, you ask yourself what is the cost of debt, you observe bonds, you observe the yield of the bonds, and you make an adjustment for expected default losses, and after this adjustment you say, this is what the capital market can expect on average to earn by holding these bonds. Yeah? And this would then correspond to this being the expected return that in an average year the equity holder can expect. And these expected returns are then basically interpreted as the cost of capital. Yeah? Expected return is reflecting, yeah, investors are risk averse, yeah? The more risk there is, the higher their return requirements are, yeah? So the expected return simply signals that they are less willing to provide the capital only if you promise this higher returns. Yeah? So if the interpretation as a cost is straightforward, yeah? And with the bonds even more so. Yeah? Investors want 3% below the quoted yield, yeah, given the interest, given the default risk. Yeah? There is also another way how you could calculate the cost of capital for debt based on beta. If you remember what I said about the market portfolio is the portfolio of all risky securities, yeah, that are sold on the capital market. Corporate bonds are also risky securities. Yeah? It's clearly securities, you can buy and sell them. Why are they not contained in P-star in the market portfolio? Why not treat them just equivalent to stocks? And this idea is basically to do this. Yeah? To say also the expected return of a bond. Yeah? You have this Tesla zero bond. Yeah? Currently it's trading at 50%, yeah, at maybe $12. Yeah? It's going up and down. And yeah, when the market goes up, that's actually good news, also for Tesla. Yeah? Probably the Tesla stock price goes up. With increasing stock prices, maybe the people say, oh, there is now less probability of default. Yeah? And maybe the 15% go down to 14%, yeah? And the bond value rises. Yeah? So if you just regress, yeah? If you take price observations of the bond, if you translate this into return observations, and if we regress them on the market return, I would not be surprised to see that when the market goes up, this is also good news for Tesla bondholders, also their return goes up, and then basically you calculate the beta in exactly the same way. Yeah? People did this before. Stephen Schaefer from London Business School did a huge amount of empirical data on the bond market and basically loves the idea to apply CAPM also to bonds. Yeah? I have to say he's one of the few people, most practitioners that I know basically say this is a nice idea when you are a professor, but in the real world we simply don't use it. And therefore it's just a nice idea. Yeah? But the average beta, yeah, as you can guess, yeah, the worse the rating, the higher the credit risk, yeah, the higher the beta is. Yeah? And 30% beta, that's already quite high. Yeah? Remember what we had here? Yeah? The best beta Edison had only 50% beta. Yeah? So we found, yeah, the bonds of high-risk companies, yeah, have more risk, more systematic risk than the stocks with the lowest beta. Yeah? Tyson and Edison both have betas below the average bond with a bad rating. Yeah? So bonds react more to the stock market, yeah, than some stocks. Yeah? So Stephen Schaefer says this is a good hint or a good indication that it makes sense to treat them like stocks and to treat them in the same framework as the capital market does. Yeah. And then Stephen Schaefer would say, yeah, measure the beta of the bond and basically treat it like a stock and derive the cost of capital from this. A nice idea, but again, not frequently applied. Okay, and now we come to combining these two things and think about the taxes. Yeah? We can simply say 50% equity, 50% debt, yeah? 50% of this, 50% of that, that's our cost of capital. Yeah? In a tax-free world, we would be already done. Yeah? But given that we have taxes, we have to think a little bit more. Yeah? So if No, sorry. That was the wrong introduction. Forget this text. Forget this text. We are on a different chapter here. We now think about how do we measure the cost of capital for a project where there is no stock listed and no bond listed. And, our project was with the Adidas tricots, the shirts, and this is not a listed company. So we can't say, just look at the IBM or the Adidas data, or just look at the bonds of Adidas. So many things that we value are private firms without a stock price or are just projects that don't have any price. And then what finance people do is they look for comparables. So my t-shirt here has a typical t-shirt risk. Let's look for companies that only produce t-shirts. And let's look at their risk as a proxy for my risk. Comparability is mean always you look for something similar that has data which you can use to estimate your cost of capital. So what is comparable? There are all equity comparables. That is the idea you find a firm that has similar assets. So your asset now, in our case, was the machine that produces Adidas t-shirts for HSV. And it may be financed with or without debt. In our example, actually, we had no debt in our case, and we implicitly assume there is no debt. And then the ideal thing is, look out on the market. Is there a firm that does similar business, producing t-shirts, with a similar degree of risk? And then we would use the comparable firms beta and this as a cost of capital estimate. Quite often, you find comparable firms, but they have all kinds of different levels of risk. Different levels of leverage. And they're leverage firms, and you know that they have similar assets, but but we know that of course both the assets and the firm's leverage will affect the risk, and therefore we will compare apples and oranges. We want a comparable firm with the same assets or similar assets and with the same capital structure. If our capital structure is zero debt, then we would like to know what would be the equity beta of the comparable firm if we would simply wipe out the debt of the comparable firm. And that is easily doable. The nice thing is, risk comes from either debt or the asset risk, and the portion that comes from debt can be easily switched on and off. And this is what we have. So a project is nothing else than a new asset compared to the existing assets, and the risk comes from both the assets and the leverage. Now some calculations that where the derivation is not done in the textbook, but this is the equity ratio. Suppose 50% is financed with equity, and the cost of equity of this, and 50% is invested. This is financed by debt, and the cost of debt is this, and this would be the average cost of debt. And we call this say, if this is 50% and cost 5%, this is 50% and cost 10%. So the average is 7.5%. And then we'll say these assets here have a cost of equity of 7.5%. And these assets are also called, think about an alternative structure with only equity. If you have only equity, then 7.5% should also be the result. Yeah? Because we're here in a simplified world without any taxes. If you, if 7.5% is the average cost of capital of this, then this is the average cost of these assets. And if we have an all equity firm, that would be the unlevered cost of equity. So the formula basically says, if your levered firm has 10% and the debt costs 5%, you have 50 of each, and the unlevered firm would have 7.5% cost of equity. So if you replace all the debt and replace it by equity, then of course the equity goes down, you have no leverage risk anymore, and the formula simply gives you the expected return. This is nothing else than saying, if you take this formula here, currently the result is 10%, and this beta is given 50% leverage. And if we put this now to 0, then this would go down to 7.5%. This is what this formula claims. And to the surprise, the formula is correct and works with the cap M. So you can basically calculate what would be the beta of that company if I change the capital structure. And believe me, leaving taxes out for a moment, it's all correct. So this is basically the cost of capital of the unlevered firm, of the all equity finance firm. And the same thing is applying also to beta. This beta here that we found for the levered firm can be simply transformed into the beta of an unlevered firm with this formula. And the formula is exactly the same. There was a percentage invested risky, was the equity beta. There was a percentage of the firm's, of the investor's money invested in debt, with a beta of debt close to 0 usually. And then you have the unlevered firm's beta. So these are useful, very useful formulas that actually every investment banker knows, even when he is deep sleeping. And the investment banker also can solve this for, now he puts RE or RD into the formula and RU comes out. Or you put the leveraged firm beta and the leveraged firm beta here into the formula and you get the unleveraged firm beta. You can also do it in a different way. Suppose I have an unleveraged firm, and this is the beta U, maybe 0.8 or 0.9. How would beta change now if I have more leverage? Then you say, and you basically solve the question for equity. You say, this is now 7.5%. This is my choice variable. If you're a private equity firm, you are free to choose the capital structure. So my target capital structure will be only 20% equity. So if you say 7.5 equals 20% equity times question mark plus 80%, and then of course you have to make a guess. What would be the debt beta with 80% debt? Let's simply assume 0. Debt has low risk at all. Then you can solve for the question mark, and then 7.5 divided by 20%, and that's of course 5 times 7.5, 50, 30, 7.5 is percent. This is the RE, the expected return on equity. So a private equity fund would simply derive from this example, where we had 10%, 5%, and 50%, that you can easily turn the expected return on equity into huge numbers simply by leveraging the firm. Okay, this example is so we call this unlever and relever. This is unlevering. Yeah? We have a levered firm, we unlever it and calculate the unlevered numbers. Yeah? And then we get, for example, 7.5% here. Yeah? And then we relever simply by saying if we would have a new capital structure with 20%, what would then be the equity return be? Yeah? And if we assume, sorry, 0 is on cost. Maybe 5% is more realistic. Yeah? So this is the expected return. Of course, the expected return, I love people here. And the expected return of debt is of course not 0. Yeah? But even if you put it 5%, then you will still receive a high number. Yeah? You can then basically translate. Yeah? You can evaluate easily the effect of introducing a high leverage into this firm and finding out what this does to the expected return on equity and to the cost of equity. The same thing, of course, with beta E. You can say, unlevered, this firm would have a beta of whatever. And then if we relever the firm, we have to guess this one, and then we can calculate this one. And then for an arbitrary new leverage ratio, we get the new beta. And this is very, very often applied by practitioners simply because you always want to make apples and oranges comparable. And the best thing is you have comparable firms that have similar assets, but they all differ in respect to the leverage. And at least the leverage you want basically to equalize. So here's an example where you use this levering and unlevering. So Procter & Gamble is so Procter & Gamble is the comparable firm with comparable investments. When we read comparable investments, this is the assets. We only talk about the left-hand side of the balance sheet. PG has a market cap of 144 and a beta of 0.55, and they have 37 billion of debt. And they have a yield of 3.1, and because this has almost no bankruptcy risk, we will take this yield as the cost of capital, and we don't do this adjustment. Estimate the cost of capital for your firm given a risk-free rate of 3% and a market risk premium of 5%. So the cost of capital for your firm, that means this is the firm, or this is the firm. When you say the firm, it is not the equity or the debt. The firm is always debt and equity or the asset. Or what we call unlevered. And when we talk about a project, of course we think about the project before seeing the finance, and we just think this is the unlevered, not debt finance projects. So what we want to solve is basically let's go clarities in the calculations. So the market, the total equity plus debt is this sum. This is the market value of equity and market value of debt. So that percentage is financed with equity. That percentage is financed with debt. The cost of equity is 5.75. That needs to be calculated. And we take the capital market line and say to the risk-free rate, we have to add beta times the risk premium. So 3% is the same interest rate plus the beta times the assumed risk premium. So this is the cost of equity for Procter & Gamble. And this is our proxy for the cost of debt, simply because this adjustment for bankruptcy losses is so small we ignore it. And then we just plug these two numbers in and say the unlevered firm has a cost of capital of 5.2%. So if we have a project that is similar to the average project of Procter & Gamble, and we basically look at the unlevered firm, then we would calculate this 5.21%. Yeah, and this is really something that is everyday's usage of investment bankers. Simply because basically you want to make everything comparable, and you, in the first place, you put everything on an unlevered basis. On an unlevered basis, you have Procter & Gamble assets, you have Tesla assets, and so forth, and they all have an unlevered beta, and this is easily comparable. And then you see assets like Procter & Gamble, they have a capital cost of 5.2%. Tesla assets have a capital cost of something below, but it's always only the assets. It is not affected by leverage anymore. If we would use we could also have used this beta function. We know that the unlevered beta is the average of equity beta and debt beta. With Procter & Gamble, it's easy to guess that the debt beta is close to 0. We just put it to 0. So we use this formula in order to understand the asset beta. And then, if we do so, we would have the same kind. That is the percentage of capital invested with a beta of 55. This is the percentage of capital invested in debt, assumed to have a beta of 0, and then the asset beta is 0.43. And we use this one to calculate the cost of capital, and then we would say capital multiplied again, 3% risk-free rate, is the new beta times the risk premium. This beta times the risk premium is 5.519. So it's not the same. 5.19 here, 5.21 here. It's a small difference. And not surprising. There were assumptions behind it that may or not hold. But it's a surprisingly small difference. And of course the textbook tries to tell you that both approaches are doable. But practitioners clearly would prefer the first approach. Every practitioner that I know would calculate the cost of capital this way. Okay, so up to now, we basically just going back. First, we calculated the cost of equity with the security market line. And we said, if we have a company like Tesla, that's easy. We take historical Tesla data, and then we get the equity beta, and we are done. Then we looked at debt and said, if there were corporate bonds outstanding, let's look at the yield to maturity of these bonds. If there was a high probability of default, let's make an adjustment for the default losses in order to have a better picture of the true expected return. And then we have both equity and debt cost, and if we have 50-50%, we could then calculate an average kind of thing. And then we thought, let's think about a project that is similar to some assets, but there was no data on this project. We observe Tesla and Procter & Gamble, but we don't observe this project. But we observe a firm that has similar assets. Let's call this Procter & Gamble. And then we want this unlevered. The project in our mind is unlevered. It does not yet have any capital structure. And we think about if Procter & Gamble assets are similar, but the Procter & Gamble capital structure is different. Then we want this project cost of capital, and we use this kind of levering, unlevering. We basically said, Procter & Gamble has an equity return or cost of equity of 5.7%, but if we unlever this whole thing, then the unlevered firm would have a cost of capital of 5.2%. Yeah? So if our project is similar to the assets but unlevered, yeah, this is the cost of capital for us. And now the next step is to think about cash. It's already here. Yeah? When we look at firms, we basically focus only on the assets. And if there is a high cash balance, then of course that will have the effect that it reduces the average risk of the assets. Just an example, two firms have, one has assets, maybe 100, and then also 100 in cash. And let's simply assume an all-equity firm. Yeah? And the other firm has the same 100 in assets and also equity. Yeah? This beta of equity, of course, and this beta of equity will not be the same. Yeah? Simply because this equity beta will be an average of cash, which is risk-free, and the assets. Yeah? So basically, you have to adjust this beta for the cash. Yeah? You want the asset beta, and you don't want the combined cash and equity beta. Yeah? Very much like here, we said this asset beta is affected by the leverage. Yeah? Here the assets are seemingly low risk, yeah? Simply because there is cash lying around. Yeah? And the stock market of the first firm does not respond as much as the other firm. Yeah? So we should do the adjustment not only for the debt. Yeah? We should do the same adjustment, but using net debt. Yeah? And net debt is basically cash, debt minus cash. Yeah? And that's why practitioners, when practitioners talk about debt, they usually talk about net debt. Yeah? They just say that this. Yeah? They may see a company with debt, but they'll say debt is actually negative, yeah? Simply because they see more cash on the other side, and for them basically the net debt is negative. Yeah? And Microsoft is a nice example, yeah? Because they had some years ago 133 billion in cash, and the market cap was 716, yeah? And they had 89 in debt, so they had more cash than debt. The net debt was negative. And now we want basically the asset beta again. Yeah? We think of some firm that has a project, yeah? And the project says, yeah, this is as risky as Microsoft assets. Yeah? And now we want basically to get rid of this debt or net debt kind of thing. Yeah? So the net debt is minus 44 billion. And the interesting thing is that this kind of what percentage is financed with equity and what percentage is financed with debt works equivalent. The mathematics do not change at all. Yeah? We have the beta formula, and say the unlevered beta, yeah, the beta of the assets, is the average of equity and debt beta, but debt is now a negative thing. Yeah? Debt is actually cash. Yeah? Doesn't matter at all. Yeah? Just put a negative number in it here. Yeah? Then here you have something like 110%. Here you have something like minus 10%. Yeah? And you get an unlevered beta. Yeah? So this is the capital market beta, 1.04. So this beta here is rather small, yeah? But in our thoughts we take out the cash. Yeah? And the beta, of course, that is this beta here, and this will be increased. Yeah? It will go up to 1.11. Yeah? And the adjustment is technically exactly the same. Yeah? So treat cash like negative debt. Use exactly the same formula. And don't be afraid to see that minus 10% of the firm is financed with debt. Yeah? Minus 10% of the firm simply means there is more cash than debt. Yeah? So debt is actually, yeah, there is a short position in debt. Yeah? In finance, we usually say investors can do everything. They can buy stocks or they can sell stocks. Yeah? If they buy stocks, they go long. If they sell stocks, they go short. In the bond market, exactly the same. Yeah? You can go long in a bond, then you buy it, yeah? And then you are an investor and you save your money. Or you can go short in a bond, then you sell the bond, yeah? And you basically are the debtor. Yeah? Microsoft effectively has bought more than sold. Yeah? Usually companies raise money by selling bonds, yeah? But here Microsoft is basically an investor. Yeah? They sold only 89, but they invested 140, and so they are net investors, and that's basically just a long position in the bond market instead of a short position. Yeah? And the negative numbers reflect this. Yeah. So Microsoft equity is sure. Yeah. This is the equity beta. Yeah. This is smaller than the unlevered beta, simply because the equity is also affected by the cash, which is risk-free. Yeah. This is bringing down the risk. Yeah, and asset betas really, investment bankers are organized usually by industries. Yeah? If you start in an investment bank, you quite often start as an analyst. Yeah? So you look at all the companies traded in the market, you observe their features, their returns, whatsoever. And of course, this is because they are comparable, they have similar assets. Yeah? So if you are an expert in IBM, yeah, you may also be able to analyze other hardware producers. Yeah? But the asset betas are also quite homogeneous. Yeah? So we have lots of industries where betas range in a small area. Yeah? That simply means if you are a car producer, you have an asset beta of a certain range, yeah? But it doesn't vary too much. Yeah? There is, I don't know what this is here. Yeah? There are some industries where asset betas differ a lot. Yeah? For example, this may be managed healthcare. I hope so. If this is supposed managed healthcare, maybe a low risk thing, if basically the insurance company takes over all the risk. Or it may be something very risky, because only the very rich can afford to pay for this, and in a recession there are less customers and so forth. So every an area like healthcare is of course very much affected by the health insurance system, and in some countries there's another system where the risk is completely different. So that explains the larger variation in something. And high risk as things are steel, semiconductors, internet retail, auto parts, industrial machines, these are all high risk. Utilities, healthcare, soft drinks, telecommunications, that is typical low-risk things, because people use their telephone every day, people use electricity every day, people go to the food store every day. That is not cyclical, it is highly stable. And if you are in that industry, you have to pay small risk premium. So this is basically the investment banking view on risk. They just look at the assets. Because they say if we buy or sell a firm, we basically buy or sell the assets of the firm. And so we want to see how investors look at the firm. And therefore we have to tear away this curtain here of debt and equity. We just assume all equity firms and look at the asset betas. And then we have a nice and clearer picture on the risk of these firms. Okay, now restart what I had started here. We come to the last part of the presentation where we actually say, okay, now we understand our assets, we understand how risky they are. We want to think about, after a takeover, for example, how we find the capital structure, and in particular what effect the tax will have on the value of the firm. So what we learned in Finance 101 is that Modigliani Miller tells us that in perfect capital markets, financing decisions doesn't affect the cost of capital of the project or of the firm. Modigliani Miller basically says, but if you take 50% or 0% or 100% debt, doesn't matter at all. The value of the firm is the value of the pie, and that's it. Now, there are many reasons why capital structure is of importance. But the biggest single reason that we apply here in these calculations is the tax. We will have a quick break in 5 minutes, but let's get that through. So, interest payments on debt are tax deductible, but not so dividend payments on equity. So if you pay a debt investor, you can reduce your debt payment. If you pay an equity investor, there is no such reduction. And the effective after tax rate is interest rate payment times 1 minus the tax rate. Because this is what you effectively pay. You reduce it from the tax bill, and then 1 minus the tax rate times the interest rate is the after-tax payment. Very similar to the Jersey payment in our case. 8-point-something million was paid to HSV, and after tax it was the net present value. So that shows up in the weighted cost of capital formula with this term. So the RD becomes RD times 1 minus the tax rate, simply because 1 unit of tax has this kind of tax reduction. So the WACC is similar to the, let's go back to the unlevered. It's always identical to this formula, the unlevered cost of equity, but we add this tax thing here. So the formula, just remember this formula and go to this formula. It is the same formula, just this added, and then we call it the weighted average cost of capital. And if you compare this with the other formula, this is basically the only difference. So the weighted average cost of capital, that also takes this tax benefits into account. Basically, it's like the cost of the unlevered firm and something reduced, and the reduction is the tax benefit. And the size of the tax benefit depends on the amount of debt that you use, what percentage is debt financed, what is the tax rate, of course, and what is the interest rate that we pay. Because this interest rate is reduced. And now, of course, we see that the more debt we take, the higher the tax rate is, and the higher the interest rate on the debt is, the bigger will be this reduction here. And this reduction basically means less capital cost, translating into more value. If we calculate the value of a firm, we can add something that is related to this tax effect. And that is what private equity firms, of course, master in particular. They say, when we buy a firm, we hope to make a bargain price. Of course, we try to find undervalued stocks, like VinFast, after a series of losses, trading at very depressed values. maybe simply bargain price. Yeah? And then even after paying a premium, yeah, we still pay a bargain price. Yeah? But then the next step is, of course, can we increase the value? Yeah? Suppose VinFast is now unlevered. Yeah? Can we increase the tax benefits and value by exploiting these tax benefits? And then we can basically lower the unlevered cost of capital, yeah, that we have currently without leverage by introducing leverage, and then we reduce the weighted average cost of capital. And just remember, what's this formula? Yeah, remember, in the firm valuation, we apply the weighted average cost of capital. Yeah? And this is RU, yeah, the unlevered cost of capital only with no leverage. Yeah? Now, if we introduce leverage, yeah, this tax effects make the cost of capital smaller. Yeah? So the free cash flows are, of course, the cash flows that come from the assets. Yeah? They are not affected by debt at all. Yeah? But the weighted average cost of capital, yeah, are affected by that because of this tax benefit. Yeah? So I said in the beginning, these free cash flows are the free cash flows of an unlevered firm. Yeah? And if the firm is not levered, it's actually the wrong cash flows. Yeah? But it is okay to put the wrong cash flows in here because we account for the tax benefit here. Yeah? And the tax benefit is basically adjusted by this. Okay, so all we do is basically introduce this tiny little kind of thing here, yeah? And it then results in the average, the weighted average cost of capital being the unlevered cost of capital, yeah? That is driven actually by the asset meter, yeah? And then we adjust something and debt, interest rate, and tax. Yeah? All three things play a role, and it brings down the capital, and of course the formula value will be brought up. Yeah, so if we have a world of taxes, yeah, the WACC is less than the expected return of the firm's assets. And with the assets we mean the unlevered assets, yeah, simply because a larger, with taxes, some part of the cash flows go to the fiscal authorities, yeah, and debt basically dictates how much of the pie is going to the fiscal authorities and how much to the investors. Yeah, so in a world without taxes, yeah, remember Modigliani-Miller applies, and Modigliani-Miller basically says Modigliani-Miller says, yeah, the financing, basically the amount of capital and equity, does not affect the capital or the project LTV, and therefore does not affect the firm value at all. Yeah, so, yeah, leverage is simply irrelevant. Yeah? And if leverage is irrelevant, yeah, we can simply, the simplest case is simply to assume there is no leverage at all, and we take the unlevered firm. Yeah? We basically take the expected cost of the unlevered firm, and then just look at the assets, and take the unlevered firm as a capital, and basically keep in mind, even if we change from unlevered to levered, this will not change anything. Yeah? But of course our world has taxes. Yeah? The taxes drive an extra benefit in here, yeah? And this benefit is valued, yeah? And yeah, and therefore, yeah, the WACC method is the I would say, the standard method that is applied by practitioners. There were other methods that do the same thing. If you can the WACC formula basically says you take the free cash flow to firm and basically assume this is unlevered. And then you basically account for the tax benefits in the denominator by using the WACC and adjusting for the tax benefit. There is also another method where you take the free cash flow with taxes and you discount with the unlevered tax thing. We will get that in later chapters. This is one model called the WACC model. This is another model, usually called the APV model, adjusted present value model. You basically do the tax benefit are basically more cash flows. You have tax benefits of debt. That means you pay less taxes and you count them here in the free cash flows. There are more cash flows due to the tax usage. But then you don't use the tax benefit again in the discounting. So both methods are valid from a theoretical point of view. The WACC method is the predominantly used method. And in a later chapter, you will see that actually both are theoretically valid. It's not so easy to show that they both must coincide if applied correctly. But just believe me for the point that it really works. Okay, one last problem, and then you have a little break. It's just a little application to calculate the WACC here. So here is information provided that the equity market cap is 100 and the overall market cap of the firm is 125. So there is also 25 in debt. So this is debt and equity. And then by assumption the equity costs 10%, then the debt costs 6%, and then the unlevered cost of capital is of course 9.2%. So this is the first question. And then with 25%, what is the WACC? And let's simply put it in there. And you see that the tax basically reduces this not so much. 30 basis points. It's not very substantial because most of the firm here is equity finance. But in the discounting, it still makes a difference. Is it a good example? Yeah, actually, it's basically gives you an idea what magnitude basically the debt savings are. But of course, if you would now go to, instead of only 20% as finance with debt, you go to 50 or 70%, the wedge would be already much larger. And then you can easily create a 1% cost advantage in the weighted cost of capital. And if you remember my duration approximation, 1% interest rate change with a duration of 10 translates into a 10% increase in the value. So if you can really, by using debt, you can decrease the cost of capital by 1%, that would translate for an average firm with 10 years maturity. The average duration of the assets is 10 years, so the average cash flow is happening after 10 years, would be 10%. And that is substantial. It's one of the contributing parts. Okay, I'm tired, you are tired. Let's have a little break. And then after the break, I show you, basically, I introduce you to the investment banker's perspective on this valuation. Over the weekend, you will work, or from Friday on, you will work on the case, and then basically you have to make this all, come to life. Let's see how the investment bankers do this.